Welcome back to the Behind the Well Show. I'm your host, Roger Abel. I've got Elias Randall in the studio today. And Elias, I think the word of the last 20-ish days is volatility and fear gripping investors. I've fielded more phone calls recently just about people being nervous about what's going on because it feels like it's chaotic out there right now. So today I thought we'd talk about a couple of different things going on, how to kind of deal with those fears and concerns going forward if you are in there. What have you been seeing? Are you getting the same phone calls? And I wouldn't say it's outright panic. It's just, hey, what should we do? And, fortunately we have financial plans created and we have some, research and rationale as to why we're guiding the decision-making, how we're guiding it.
Well, so what's interesting about this recent little sell-off, and to me, this should have been expected at some point because we're within reasonable, just normal trading activity, but there's a spectrum of concern all the way from I think I might just need to get out and not be an investor anymore. And I actually have a lot of clients that they think it's a short-term event and they're really not even concerned about it. But the other day, someone tried to convince me that they should sell all of the investments in their IRA. And just so you know, this person's not a 100% stock market investor. Diversified portfolio, invested correctly for their age, their goals, their time horizon. So she was trying to convince me that she should sell all of her investments, cash out her IRA, and put the money in the bank. I said, okay, well, just talk me through that. What about that would be in your best interest? She said, well, in case our country collapses. So I asked her, well, if our country collapses, how much money is the bank going to give you that you've given them in deposits? Well, all of it. I said,
No, I don't think so.
I said, I don't know about that.
Well, the country's collapsed.
I explained that to her. So anyway, got her talked off the ledge into making a better decision as an investor. But I think here's what's unfortunate is people, there's certainly a certain percentage of people that they're losing the reality and the perspective on what the capital markets are, what they do for people. And whether you like who's president or don't like who's president, I have a hard time believing just one president over a 4-year term can take America to a collapsed society, right? Doesn't that sound far-fetched?
People think it's happened in 45 days.
Which sounds even more far-fetched.
Here's the problem. This has been pretty quick. It's been a really quick correction. That's what it is. It's a correction. And if we go back and look at the history of all of the bull markets, corrections are totally normal. Nothing goes straight up forever. Like eventually there's going to be a dip, it's going to reset, and then it'll go up from there. But one of the problems, and I ran into this the other day, people are anchored to the highest number their account ever hit. I mean, people forgot we're back to levels that we saw September. So 6 months ago is where we are in the stock market world. Pre-Donald Trump getting elected, the S&P is back to the September 2024 level. Okay? Year to date, as we film the show, and I caution Molly, our producer, as we might want to put this show out sooner rather than later, mostly because things are changing rapidly. But right now, the S&P 500 year to date is down a little bit more than 6%. What in the world are people losing their mind over? It's 6%. Now, from the all-time high, which people are getting anchored to that number. What I mean anchored, someone's in there checking their account balance every single day, which isn't healthy. Who needs to check their account balance that's buying mutual funds and ETFs for the long term every day? You shouldn't. It's not healthy. But now people are anchored to that number. So then the drop looks bigger because that was the highest it ever hit. Well, it's not reality. If we look back 30 years ago when people got paper statements, most people wouldn't even know what's going on right now. And by the end of the month, who knows? Your account could be right back to where it was. It's moving quickly. So one of the things we want people to be aware of, don't get caught up in anchoring bias. Look at the numbers. What has it done year to date? And that's only if you're a 100% S&P 500 investor. What parts of the market are performing really well this year? There are parts. Dividends, strong companies, bonds. I think the global or the US bond index is up like 4% year to date. Bonds doing well. Oh, and what's the other asset class that's been horrible for the last decade that's absolutely trouncing the US today? International.
International.
Developed international is.
There's actually some countries that their markets are really doing great right now.
I want to say the DAX is up like 27%. I mean, so what it goes to is the last 4 years, 5 years, you have not been rewarded by having a diversified portfolio. You've been punished. You have been, right? If you owned, high quality dividend paying companies the last 5 years versus owning the riskiest asset classes, so let's just call it tech and S&P 500, you look like a moron for having that in the portfolio. If you own international the last 10 years, why in the world would you own that? If you own bonds the last 5 years, those didn't do well. We saw the worst bond market in 2022 ever. But oh my gosh, all of a sudden a diversified portfolio is working. I had somebody call me up, this is just the other day, and say, hey, I think it's going down where I think we need to get out. And he goes, what's my allocation? So I looked it up. He was 80-20, 80% stock, 20% bonds. His account's down 3%. 3. I go, well, and what's happening? Why people are losing their mind over 3%?
That's only year to date.
Yeah. I go, year over year, you're up 11.
If you ran a report showing returns for the last 2 years, I'm sure this investor's still good. They're still making money. But people look at that, year to date. Well, that's 3 months.
It's wild. It's wild. So if you're listening to this, stop checking your account balance every day. Do you remember in 2022 how many people came in this office that were clients of ours? And they said, we had people not wanting to come in for reviews because they didn't want to talk about it. They hadn't checked their account statement. They didn't know what their balance was. They're like, I'm not going to look because I don't want to get depressed about it. There's nothing I can do. I know it'll come back. That's what you need to do right now. Stop checking your account balance every day.
So between anchoring to a number and then just too much media, which it's funny because those two things are pretty common themes, but I feel like people could have a media filter right now. Just quit watching all this news. Because if you're watching all this news and the way it's presented and how exciting or angry it can make you, they are very intentional about getting into your emotion, or else you wouldn't watch the program, right? If the news came on and it was boring and didn't get you excited, you're not turning it on tomorrow.
I have a great example of this for you. Yesterday, I was driving home, and I listened to CNBC. That's the station of my choice to
Money Channel.
Yeah, Money Channel. That's all I watch. I don't watch any other news channel. I don't watch any other news channel. I watch CNBC. And they had someone on there, and they used this line. They said, if you're a trader, you need to be doing this. And I want everybody to let that sink in. CNBC, in the financial news media that runs shows every day, it's made for traders. The information they're giving out isn't all that relevant to long-term investors. Because they're talking about when to get in, when to get out. They're buying and selling individual stocks. And at the end of the day, most of it's not relevant to most people. You can't time the market. The person who wanted to get out, I said, you know what the probability of timing the market is? It's like 0.0 with a couple hundred zeros before the next number.
Well,
and they're like, oh, okay.
And the other thing with now the people, okay, even you're watching CNBC, the people on those programs, I'm not saying they're stupid. They're very smart people, but right? We just in general, like, okay, that person's on TV, so we assign so much authority and expertise to what they're saying. But if they're giving information about how to trade your account, and there's a difference between being a trader and an investor, although that person may be an expert and you may really believe what they're talking about, the first question you have to ask yourself is, what type of investor am I? Because if you're a trader, then, well, okay.
This is relevant. If you're a trader, this is relevant.
If you're a trader and if you are actively trading all the time, you should have been prepared for this, right? Because you're so smart, you know better.
Well, and arguably you have liquidity so you can make more trades. Like if you're stuck, like a trader is either going to get out and go somewhere else or they have liquidity.
Right.
The average investor doesn't have liquidity.
Yeah, they're just putting money in. So I think that's a media filter would help people. And then also I like your thoughts on anchoring, because that's an investor behavior that really it gets people. And it gets you too negative. I had some folks that they're a little bit concerned the other day, and what their concern was, which again, year to date, I think their portfolio was down like 2 or 3%. So we're talking about a non-event in the first 90 days of the year. Well, I could have with that, but they look at the dollar amount, right? We talk about that, how the more money you have, you just look at the dollar amount. I could have paid off my truck. And I didn't say this, but I'm thinking, well, if it was so important for you to pay off your truck, why haven't you shared that with me?
Why didn't you do it? Why didn't you do it 25 days ago?
Right.
When the market was on the all-time high. Nobody was calling me 30 days ago saying, hey, I think it's time to sell. Nobody.
Right. That's what I'm getting at. If I knew, if they would have said it was important for them to get this truck paid off last fall when I was meeting with them and talking through their stuff and everything, market's up, I would have said, well, it's probably a good time to just do it then. But no one wants to take, when you tell people, hey, things are going great, sell, take some of your chips off the table. You just told me you want to pay off some debt. Well, they don't want to do that because I want to see how much higher it can go.
Well, people are greedy and people are fearful. Those are the two emotions that run it. And it was funny because I asked this individual, I said, okay, so we sell today and it goes down 10% more in the next, 2 months, and you're on the sideline. And then all of a sudden it turns and it rips, because a lot of times it's not a grind higher. It rips and you miss it. When are you going to buy back in? When are you getting back in? Because catching the market bottom is 100% luck. There's only one way to catch the market bottom, and that's to be dollar cost averaging every single day. And then, you'll catch some at the bottom. But there's no way to catch the bottom of the stock market. So I said, well, do you think when it turns, it's just going to slowly grind up and give you opportunity? Or the whole time is going to make you think it's going lower because you already think it's going lower? And my point is, I go, you have 8 years till you're actually retiring, which means your time horizon's like north of 30 years. I go, if you wake up in 6 months and don't do anything, your account value is back. What good would it have done to get out of the market? Because you got to figure out when to get back in, you're in. And he said, well, then I'd have some extra powder, if I wanted, he said, when it goes down, so I can buy more. I go, well, no, you won't do that because you're going to think it's going to go further. And I said, and you do have more dry powder. You have a 30 plus year time horizon. You could rotate that 20% of fixed income into equities and sell that fixed income high and buy some equities low. I said, you have dry powder. You just don't realize it.
Otherwise known as a rebalance. You could rebalance your portfolio.
So, you know what this goes back to? Just the simplest things we talk about. Diversification. Diversification might get sexy again. It hasn't been very sexy for a long time, right? The way to do really well the last decade's owned 7 companies. Diversification, dollar cost averaging, and rebalancing. You just do those 3 things and you're likely going to be pretty good. Molly asked me this.
Here's the issue though. That's too boring, and that doesn't sound like, how many people out there that, well, there's a better way.
No, there's not.
I know, but I talk to individuals, I talk with people, and there are people that just, I feel like sometimes if you give someone, it's like, to me, it's the equivalent of a coach that's needs to be too fancy, right? Like the best coaches just execute the 101.
What they're good at. What they're good at.
Yeah, and what their players are good at, right? But every good program is fundamentally sound, and then they craft the season according to the strengths of the team. Where there are some coaches that they want to fit every player and every group into the same box. Well, these are the things I believe work, so this is how we're going to do it. To me, that's like the trader that just thinks they're going to outsmart. Like you're going to outsmart every other investment professional and every investor in general. It's really because the market is just a big reflection of investors and what they're doing. So you're smarter than all those people combined.
You know, it's funny. Who was I watching yesterday? Was it Josh Brown? Somebody was talking about the stock market, and they said, you know, the stock market doesn't care about any of the stuff going on in the world. It's a reflection of what's happening, but they don't care what your race is, your ethnicity, your political affiliation. The stock market doesn't care. All the stock market is doing is pricing future earnings. That's it. And applying a multiple to them. The stock market doesn't care about any of this stuff. It's just looking at a company, pricing the future earnings and applying a multiple to them. That's it. It's that simple. And there's a lot of companies that have really strong earnings growth, and someone says there's going to be, you know, it's going to collapse. Well, what basis is the stock market going to collapse? It could. I don't know. But what basis? Like, it's literally people that couldn't tell me what earnings even mean that are going to say, wow, it's going down. It's going to collapse. Yeah, like when I mention what some indicators are, they don't even know what the indicators are. These are all just gut feelings, and those people should not be trying to be traders.
No, they shouldn't. And I think I've asked a few people recently, do you think, right, regardless of, because a lot of this emotion and stuff and some of the fear, it's really politically driven. I go, so.
Oh, no, not a little. It's a 100% politically driven. Because if you're a conservative, while you're not thrilled with the result of the stock market so far, you also have faith in what's being done. If you're more liberal, you think the world's coming to an end. Right. And neither one of those things are accurate. It's in the middle.
And even with all that, are the companies still good companies? Do they know how to make money?
Dude.
Right? And even if they get the rules changed on them, like when you buy, just for example, you buy the S&P 500 or you buy stocks within that group, just to be in that group, you're one of the biggest, best companies in the entire world. So just how, like, we have political stuff going on. Are the companies going to throw in the towel and go, oh man, we got all this political stuff. Let's just stop trying to make money and be a good company. That's never going to happen.
And for the stock market to go to zero, all the companies means every company's worthless.
Yeah, they've all gone out of business.
And I'm going to share this with you. There is a technology company that may or may not make phones. Study out there. They'd rather give up their second car in a household of two people than that phone. So you think that company's going anywhere? Consumers were polled and say if they had a household, two people and two cars, they'd rather give up the second car than give up
a cell phone's a consumer staple now. It's a commodity.
It's not even a consumer staple. It's a necessity of life.
Ooh, it's a consumer necessity.
Well, I mean, we proved that. Didn't we give out a bunch of phones about a decade ago to people?
I don't know.
Yes, we did. Yes, we did. But it is. I mean, go try to survive. Okay, you need to get into your bank account. What do they do? Two-factor authentication. Yeah. What's your cell phone? Like, a cell phone is a necessity part of life. So how is a phone company going to get that battered and destroyed?
So I wonder if what people would say, would you rather have a bike and a phone or a car and no phone? I'm guessing if you lived in depending on the town.
Even here.
If you lived in if you live here where we live, you could have a bike and a cell phone.
Dude, I have a fat tire electric bike. I'd get around. I mean, it wouldn't be as convenient. It'd be tough to take the kids anywhere. You know, I guess throw a cart behind you or something, but
Yeah, you just
I
throw a
think-
wagon.
I think the vast majority of people, well, and there's another reason, because things like Uber and taxis and all those things exist, which makes that idea much more viable.
Yeah, I'm giving up my car. No, I'm not going to do that.
Your wife will be so mad at you. But it also got me thinking, people are really feeling down right now, and, sentiment is dropping, mostly because just it's unknown. Like, we just don't know what's going to happen. But some of it is self-induced. I pulled up my favorite station, CNBC, had an article out there that say more Americans fear missed payments. The number of people polled that thought they would miss a minimum debt payment over the next 3 months rose 15%. This is the highest level since April of 2020. So think about this. People right now are more fearful that they can't miss. It's almost as fearful now that they can't make a payment as it was in COVID in the beginning, before they lost their jobs. This is self-induced. They're out of money.
Right.
So this is really all self-induced. And now, they've lived on this easy money. They lived on credit. Everything's maxed out. Now they can't make the minimum payment. We started talking about this a couple years ago. Buy now, pay later. Phantom debt. There's a lot of unknowns out there in the world of debt. And, I was talking to someone the other day, and I said, how you take a lot of risk out of your life? Just don't have any debt. If you don't owe any money to anybody, think about it, if you don't owe any money,
if I don't have any debt, I can't have the nice vehicles that I want to have, and the nice house that I want to have.
Well, okay, those are
the TV I bought and buy now, pay later.
Yeah, because my credit card was maxed out.
Yeah,
I know
have all that stuff.
So
I can't go out to eat 5 nights a week if I don't have any debt.
But it's funny because I read an article like this, and it puts all of the blame on the world economics, right? Like, people are going to miss payments. Well, whose fault is it that they're going to miss a payment? It's their own.
Yeah, there needs to be a little. I feel for people. Like, if you're in a tough spot, I feel for you. But I also know the reality of how people treat their money, and most people don't live on any kind of budget, don't prioritize their savings. I mean, 90% of people in America, that might be high, but it wouldn't surprise me. 90% of people are never going to have any sort of meaningful wealth or savings, investments. But what they're good at? They're really good at spending money. They spend their money before they even make it.
It's easy to see why. We live in a society that it's okay to borrow money because our government does it every single day. And they're not scared of it. So why would the consumer be scared of it?
I think if
you run a budget deficit. I mean, what's a budget deficit mean? It means we actually don't have enough money to pay our bills, so we have to borrow it. That's just like running a consumer deficit. So why would the consumer be scared? We're not scared of the society for our government, but why would they be scared? They're going to get a bailout, file bankruptcy.
I think there's just a decision that people need to make, that you're either going to, adult with your money or you're not. I also, and there's probably a big gap in personal finance education too. Like, if people really understood how simple it can be. Now, easy is probably not a good word because it takes discipline. And anything that takes discipline is inherently not easy, right? Like, I want to take the easy way out too, right? Because it's comfortable and it's easy. But if you got to have a certain level of discipline and put some priorities in your life to say, hey, I don't want to live paycheck to paycheck. I don't want to be someone that's never financially independent. Okay, well, if you set out to do those things, and who's a great example? Dave Ramsey, right? Those baby steps that Dave Ramsey talks about. If someone, I don't care who you are, if you blindly followed those, regardless of, well, he's right about this and wrong about that, and instead of debating it, if you just executed that program and those steps, it will work for you. 100%. There's no way it won't work, especially if you start at a young enough age.
Well, we're a society of easy way out. Like, nobody wants to have discipline.
Yeah, it's a choice. You have to choose to be
you can look. Think about this. GLP-1s. And whether good or bad, I've actually had a discussion with a doctor. When we were at Focus last year, I asked about GLP-1s. And for people that don't know what GLP-1s are, it's the weight loss drug, right? Ozempic and all the other different companies that offer it. And the reason it's so popular is because it's like instant results with no effort. The effort is giving yourself a shot and feeling like crap. No effort. Many people, not everybody, there are people that have, disorders, thyroid disorders, et cetera, that would be challenged to do that. But I know people on GLP-1s that don't need to be on GLP-1s. It's just easier than going to the gym. And you can tell who they are because they were never that overweight, but now they're really skinny. Like, oh, really? That happened in 90 days?
You're calling
me kidding.
Out.
How's your gym workout?
For how skinny I am.
You could use some. No, I'm kidding. But it's the easy way out.
I think people know I'm not on them.
I'm definitely not on them. But it's just the easy way out, and that's okay. I'm not, in no way is it negative about people using them, but you could get the same result by watching your diet and going to the gym. But it would take a high level of discipline to get there. In fact, my wife and I, she debated this with me. And she goes, well, yeah, but people aren't improving their heart health and all those different things when they take these medicines. I said, yeah, but even if they didn't take them, they're not going to work out and improve their heart health. So they still have elevated risk factors. So when we were at Focus last year for LPL, I don't know if you remember, we went to a little breakout session or event for the Good Advisors Finish First group.
Okay.
And there was an individual there. I think maybe he wrote that Outlive book. I think people have heard of that because I got the book and then I just started having a conversation with him. He's a doctor and he works in the medical space, but investing ETF space for the medical field. And I asked him, I said, what are the long-term effects of these drugs? And he goes, well, so far what we know is the long-term effects are a little bit unknown. He goes, but when all of a sudden you take somebody that can lose an exponential amount of weight, you start eliminating all of the risk factors that are out there. You start eliminating risk factors like heart disease, diabetes, cholesterol, all the bad things out there. He goes, so in a lot of cases, even though the individual is not getting exercise and improving their heart health, they're massively improving their overall health. And I know I went on a little tangent, but I just wanted to let people know what they are. So I think, if you're listening to today's show, I understand it's hard to kind of tune out the noise, but just be cognizant that you don't have to check your account every day. Work at just doing what good investors do, which is dollar cost averaging, diversifying, and having a media filter. Those things will really help you get through the tough times. And honestly, they're not really that tough. A 10% correction is a normal correction. We talk about the drawdown that we typically see in any given year. It's between 10 and 13%. So most years we average that and we finish positive in the markets about 75 to 80% of the time when that happens. So with that said, keep a level head. I hope you enjoyed the show today. If you enjoy this content and you enjoy listening to our show, do us a favor, subscribe to the podcast, subscribe to our YouTube channel, and you can follow us on social media, btwellshow.com. If you're looking to get a financial plan and need help understanding why you should have a particular asset allocation and how to diversify your portfolio, you can go to btwellshow.com. You can click Get Started, or you can click the link in the description. We'd be happy to help you. With that said, Elias, do you have any closing remarks for today?
I do not. Thank you for listening. See you next time.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets.